Hi, everyone, and welcome back to the AI Interconnect podcast, where we explore how technology, AI, and investment are shaping the future of real estate, finance, and innovation. I'm your host, Laurent, and today we're speaking with someone who brings a unique perspective at the intersection of entrepreneurship, venture capital, and applied AI. Joining me from Austin, Texas is Nikos Iatropoulos, and managing partner at IA Global Venture. Nikos, great to have you here on the show.
Hello, Aaron. Thank you for having me. Greetings from Austin, Texas, and happy to be here.
Wonderful. Then let me clear something. It's not an AI Global Venture, it's IA Global Venture. And I just heard that it's International Accelerator, or the two co-founder initial, Iatropoulos and
Angelu.
Okay, that's great. Let's have a great conversation. And you had an interesting journey from being a software engineer and founder to now running a fund focused on helping immigrant entrepreneurs establish their US headquarters. Let's start from there. What led you from launching and selling tech company to supporting others as an investor?
Sure. So I started as an engineer, as you mentioned, a long time ago. So I haven't written code for a very long time ago, but I always had an interest in software. And after studying it and spending some time in that business, I ended up launching 3 companies over a span of 16 years. And I was an immigrant. I grew up in Greece. So I moved to the US, and this is where I've made my career. So I saw a lot of the issues that immigrants were facing, but I also got to meet many very successful immigrants here who have left their homes and came to live the American dream. So I always admired their grit and their perseverance and their attitude towards success. So fast forward to 2016, I moved to Austin from California, and I met with my now partner, Angelos Angelou, and he had just launched something called the International Accelerator, and also an immigrant, also recognizing that immigrants tend to be very successful in the US. And I joined the accelerator as a mentor. And the goal of the accelerator was and continues to be to bring in companies from all over the world, help their founders have a soft landing in the US market and launch their business ventures here. And to date, it has brought in founders from 29 different countries. So I always had that close to my heart. I understand a lot of the challenges, but I'm also impressed daily by the amount of effort and work and the, failure is not an option attitude that a lot of these immigrants have.
Yeah, I mean, that's a great story and very strong foundation. Then what did those early experiences as a founder teach you about uh, identifying real potential in startups, especially those using AI today?
Yeah, it's as you know, the market has changed dramatically from when I was a founder. So I launched my first company at the end of '99, early 2000, at the peak of the internet excitement and bubble. But putting that aside, I think what's fundamentally changed is that the bar to launch a company is significantly lower now than it was back then. So when I launched my first company, the first $1.5 million, maybe $2 million that we raised went towards infrastructure. So we bought Sun servers and Oracle licenses and set them up at a colocation facility and had someone managing those. And this was all before we started building an application that we would market. So it was required capital, it required infrastructure. Of course, the cloud came and all that went away. And it, for a while it was effectively zero cost to get started up. Now I would say it's negative cost because all of these cloud providers are competing to get startup. So they give them credits so you can start and launch a company without paying anything for a while. And now there's a new wave to that, which is AI. So if you rewind 10 years ago, it was very much about, let's hire engineers. So the engineering force was what was taking the effort and the capital, and that's where people were focusing on. Now, especially in the last year, You're seeing a lot of vibe coding and abilities of AI to do a lot of that coding initially. And I think we'll see tremendous improvement in that age. So now the bar is lowered even further, and maybe not yet, but I think that within the next 12 to 24 months, you will be able to launch a software company without having any real software engineers in the firm and just having, let's call them product people or people who understand the market that you're going after. You can do that to a certain extent now. I don't think it's quite there yet to be prime time, but it's not very far away.
That's right. It's amazing. Um, okay, you have said that each new OpenAI release can kill 100 startups. And that's a striking comment. What do you mean by that?
Well, yeah, let me step back on that. So,
Yeah.
OpenAI, and I'm using OpenAI, but really any foundation model company, they're competing with each other. They're looking to broaden the capabilities and deepen them at the same time. So when ChatGPT first came out, many would argue that that was what forced Google to release a little bit earlier than they were expecting, and obviously many other companies have kind of jumped on board since then. And they're each following a specific strategy in terms of their business, but in terms of the capabilities, um, they're fairly close. And again, people are going to disagree with me on this, but depends on your use case. Now, the broadening component is what potentially could kill a lot of startups. And it's a joke we have in the office that, again, we use OpenAI because they're the best known, but we see a lot of startups that come to us pinpointing something that currently ChatGPT cannot do and focusing their business and their product or creating a product to fill that void or gap because they see an appetite in the market and this void, and they say, okay, we can fill this void. Effectively, what they're doing though, is they're using ChatGPT or whatever, LLM really through their APIs, Llama or, Anthropics, it doesn't matter, to create a wrapper around that and fill that void. When that wrapper is thin, and what I mean by that is that it doesn't come with a deep understanding of the business. It doesn't come with proprietary data from the vertical that they're going after, and it really focuses on a capability. It's very easy for that to disappear the next time there's there's an announcement. And the agentic AI is a good example of that. Yeah, I remember probably 18 months ago, we had a number of companies coming and say, okay, we're going to create your marketing agent or your outbound sales agent. And they had all these capabilities that didn't really become better with time. So there was no feedback loop in terms of them learning from their own proprietary data. So all they were doing effectively was creating a UI on top of an API, which was, let's call it OpenAI's API. And a lot of these companies, I would assume, I'm not in touch with all of them, but I would assume are no longer around because a lot of that you can do on your own now. Now, that being said, I do think there are opportunities to create wrappers, and there have been cases, Harvey, for example, for legal, Jasper, there's a lot of companies that have been very successful that have focused on the vertical, but the key there is ideally starting with proprietary data. But if you don't start with data, then as soon as you acquire users, and you better be very quick at doing that, that usage helps your product become better in a way that the underlying model can't replicate because they don't have access to all that data. But it is something we deal with every day because we constantly see these companies coming to us and pitching us what we feel is a very thin wrapper around an existing LLM.
Yeah, well, that's very, very, very interesting. Okay, let's talk about IA Global Venture. It's a sister fund to the International Accelerator, which focus on foreign-born founders who wants to enter the US market. Can you describe how the model works?
Sure. Yeah. So as I said, I joined the International Accelerator as a mentor about 9 years ago, which was early days. I think it's been around for close to 11 years now. And they're two separate entities. The International Accelerator obviously has been around for longer. And traditionally what they were doing was they were bringing companies. It used to be a 12-month acceleration program, so a very long program when it comes to accelerators. And there were reasons for that. Now it's been cut down to 6 months. It's still a long program. But as the companies apply and come in, they have to worry about how do they come to the US. So there's a visa component that the accelerator helps them with, and that depends on which country they're coming from. But to date, the accelerator has had a 100% success rate in getting visas for their founders. When you come to the US, oftentimes these founders are coming for the first time, definitely have never lived here before. And so they have to worry about renting a place to stay, health insurance. And a lot of these things in the US market, unfortunately, are not as developed as in Europe. So if you come to this market, it always surprised me how whenever you want to do anything, lease an apartment or get a credit card, they always look at your credit score. And the credit score, which was an interesting realization I had, is only based on money that you've borrowed. So you can have millions in the bank. You can be very successful. If you've not borrowed money, whether that's through a mortgage, through a credit card, or through an auto loan, you have no credit score in the US, which means that you can't go and rent an apartment. No one's going to rent you an apartment. So, they talk about the US kind of promoting this debt, and that's, part of it is you need to develop that credit score. So to start, we give every founder a place to stay, an apartment that is paid by the International Accelerator for 6 months. It used to be a year, now it's for 6 months. We help them establish a credit score. We help them get health insurance, get an international driver's license. So a lot of things on the personal side when it comes to them having a soft landing. One thing I thought was pretty interesting when I first got exposed to the accelerator, and I have to mention here because I haven't come across another program that has this, is that when the founders first arrive in the US, they spend the first 2 months living at Angelos's place, my partner's home. Texas homes are fairly large, and he's an empty nester. His two kids are old, so he and his wife are very understanding and usually have 2 or 3 founders staying with them at any point. And I thought that was strange when I first heard it, to be honest, but I see the wisdom in it now because it truly is a fantastic way to get to know people. There's nowhere to hide if you're living with someone, and you don't just see them in their business mode. You actually see how they react. Do they pick up after themselves? Are they respectful? Do they make their bed in the morning? You get to really experience their character. And, there's a lot of tools, there's a lot of AI. We talk about this all the time, but entrepreneurship is, fundamentally a business of people. You need to be able to interact with other people and build a team and inspire a team and be collaborative. You get a really good sense of a lot of that. So oftentimes I'll sit with Angelos and he will give me feedback from those experiences, like how do people spend their evenings and how do they interact with other founders? And those are very insightful and usually things that you don't get. So the International Accelerator handles all of the kind of personal soft landing elements that are needed for someone who's coming to the US from abroad. And then, of course, there's the business components. On the business side, typically what happens is there is a foreign entity that has been established, but when they come to the US, we set up a clean Delaware corporation. The foreign entity flips the cap table to the Delaware company. So then we end up having a foreign-owned subsidiary of a Delaware corporation, and then all the future business happens at the US company level. Now, we do want to maintain the foreign entity. Typically, that houses the engineering talent, which is, as you can imagine, significantly cheaper than U.S. talent. It also is significantly more loyal, which is something I hadn't realized until recently. But having dealt with a lot of companies in the U.S., and I'm sure you read the headlines, where people are throwing around insane amount of signing bonuses and salaries and 5-year, it's almost become as lucrative as being in the NBA to have a good degree in AI. So people don't stick around. They'll go to a startup and 6 months later they might leave. And you don't really see that if the companies are, coming out of Eastern Europe or India or, South America, which is really where most of our companies are coming from. So the accelerator handles their incorporation. Then they handle all of the back office. They do the cap table management, all of their legal work, the finance, putting together a financial model, filing tax returns, licenses, whatever is needed to have a a corporation that is properly run in the US. And then there's a business component, which consists both of marketing. So we have two people within the accelerator. One is our creative director that handles all of the collateral events, planning, etc. And then our chief growth officer that works with the company on their GTM strategy, how they approach the market, which might be different from their home country. And then there's a business development team, which has effectively three people. It's Angelos and two directors of business development, one for US and one for international. And they make tons of introductions. So when the company is ready, they have their collateral, they have their GTM down, and they've identified the vertical that they're going to go after, we're going to make those introductions and open doors and accelerate their business development. So that's what the accelerator had been doing traditionally and continues to do. The other component was that as these companies came in the door, the accelerator was making a $50,000 investment across the board for every company, and everything else was provision of services. So what Angelos had been telling me, as we were having lunches over the last few years and talking about the progress of these companies, some of them have gone on to be very successful. He said, I could pick the winners in the first 3 to 6 months. We spent so much time with them. They were in the office. And if I had waited for that 6-month period, instead of putting $50K in every company, I would have gladly put in, $500,000 in, 25 to 50% of them. And that was really the kind of the seed that got planted to launch the fund. So the fund does exactly that. We're a sister company. We get involved, or we meet the companies when they're at the very end of the funnel. In terms of the acceleration selection, the accelerator gets between 5,000 and 6,000 applicants each year. They go through multiple layers of screening and due diligence. The goal is to accept 12 companies a year, about one a month. There's no cohort system. It's a rolling admission as they get their paperwork done. And then once the companies get to that final stage before they get accepted, usually we'll have an informal meeting with the fund. The fund doesn't make any commitments at that time, but we have an internal discussion where effectively what we do is tell the accelerator whether we think this company could be fundable if they come to the US and execute on their plan. And then once they come to the US, usually maybe a month or two after they're here, we have our first official meeting where we get to meet the founders. They pitch the company to us. And if we like what they're doing, then we enter into an agreement whereby we might make a small investment at that point. We may not. We've done both, depending on the capital requirements. Usually we sign a 6-month option agreement with predetermined investment terms. And then we roll up our sleeves and assume we've invested in the company. And we work with them as if we are on their board. We work with them on strategy. We take them to meetings. We introduce them to our LP base. And effectively what we're observing is how they're executing. And then when those 6 months, when we get closer to those 6 months, we don't have to wait necessarily for the 6 months. That's when we make an investment decision and then execute our option. So what that allows us to do as a fund is really get to know the entrepreneurs in a way that most VC funds don't get an opportunity to do until after they write a check. And at the same time, it allows us to not worry about making them too successful so that our evaluation, sometimes it's just one introduction, Laurent. You make an introduction to a C-level exec and that's your breakout customer, and the valuation, triples overnight. So we don't want to be in that situation where we make that introduction and then we come in at a higher price. So we that's why we sign that option, lock in the terms. And then it's obviously to our benefit to increase the value of the company as much as we can. So that's how the existence between the two entities is. When I talk to founders, I tell them that they should view the accelerator as a separate entity and a separate decision. They should not view it necessarily as a stepping stone to the fund. Firstly, because there's no guarantee in capital. We're not going to be investing in every company out of the accelerator. And secondly, because I do think the accelerator on its own has a lot to offer, including access to other capital sources. We don't have a unique deal flow from them. But fundamentally, the assistance that they get on the business development front and the soft landing and kind of entering the US market is really second to none. It's a very unique program. And then, of course, there is the opportunity of getting funding from the fund.
I love it. Thank you. It's that's a complete ecosystem.
Yes,
For sure.
And I touched on it a little bit, but I do want to mention because I think we're involving. So when you think of it, you have the accelerator, you have the fund, and then we have the investors in the fund, our limited partners. And our limited partners, it's a relatively small fund. It's 50 million. So our limited partners are mostly very successful, high net worth individuals from all walks of life. Entrepreneurs, business executives, from finance, from all kinds of industries. And a lot of them are at a stage where they want to give back. They want to support. They're happy opening some doors. And we've had situations where we have a startup that comes and says, hey, I really would love to meet with someone from this industry. And if we could have them list the 5 top individuals in that industry, often the person we'll introduce to them is one of those individuals. So we have a very extensive, and it doesn't have to be necessarily one of our LPs, although often they are, but these people have their own network. So I can go to someone and say, hey, we're looking to, get introduction to the CMO of a CPG brand, and that CMO might end up being Coca-Cola's CMO. So it is a remarkable network. It's obviously up to us to tap into it. But I think for companies that are coming to the US, having access to that kind of decision making and seniority is really amazing for their companies and their ability to grow fast.
Yeah, no, that's great. Yeah, networking is very important. And okay, then yeah, you have help. I mean, funders from more than 30 countries, I think, into the US. What's the biggest challenge these founders face when relocating and scaling in the market like the US? Because we haven't talked about that.
Yeah, I think it varies on a number of things. One is where they're coming from. So if we start at the beginning, the first thing they need to do is get a visa, and that really depends on which country they're coming from. Now, when they come to the U.S., they typically come here for that 6-month period to establish things. They go back home, and they fall into 2 categories. They fall into a category of founders that want to move here permanently. They want to bring their families here, and hence they want to go down the path of getting a green card and eventual citizenship. And then you have other founders that really want to come here, build a team. Usually it's a business development team and establish their business here, but either because they really want to go back home or because they're sometimes much closer to the technology side versus the business side. They want to be close to their engineers. So I think the challenge a lot of times is just making that lifestyle and life decision, because if you're going to move to the US from Romania or India or wherever and bring your family, it's a big decision, not only for you, but for your family as well. And, I was talking to someone yesterday who is not in the accelerator, but we just happened to have a conversation. He's from Denmark, and his challenge was he came to Austin and he loved Austin, but, when he moved here, his kids were too old and they couldn't, find the right friendships in the school system. They were just used to different mentality or group. So it didn't work out for his family. So there's a lot of personal issues of moving to a country that they have to deal with and address. And often it's not their own personal decision, it's a family decision. I think another thing that surprise, there's 2 things that surprise a lot of our founders, almost all of them, is the cost of healthcare and the cost of attorneys in the US. Both of those are very high. And, they have to kind of figure that path out. The other thing that's different is that the US is a vast market. Usually our founders are coming from either a smaller country or a country where there is a much smaller group of the elite, where everyone kind of went to the same high school and everyone knows each other. So you could be coming from a country that has 50 million people, or more, but effectively there is this kind of small bubble of people that know each other, and usually that crosses multiple industries. So I'll give you an example from Greece, because that's kind of the country that I know the best. Greece has 10 million people, but really if you go to Athens and you look at the top executives in, across industries, they went to 2 or 3 different high schools and they kind of all know each other and go to the same places. It's a very tight network. So everyone is kind of 1 or 2 degrees away from each other. And as a result, what you find often is that people jump between industry and industries. I have a good friend who and collaborated, 25 years ago. There are three major carriers, mobile carriers in Greece. So he went from one to the other. He worked for all three. Then he decided, having, spent probably 15 years in that space, probably more, that I want to try something else. So he went into banking, which has no connection with that space. And then he ended up the two major Greek banks at COO level. So you don't really see that in the U.S. market. So the U.S. market, because it's so big, when you kind of focus on a particular industry, you tend to learn the people within that industry. You tend to network with people within that industry. Maybe depending on where you live, you might, your kids might be going to school with another CEO of a company, but effectively, it's a much more fragmented network that doesn't cross industries as readily as it does in some of the places they're coming from. So I think the one thing that surprises them is that it's not as easy to network here as it is back home. Obviously, geographically, it's a much bigger country, and you do have pockets of concentration when it comes to specific industries. But in essence, you could find big companies all over the U.S., right? So maybe it's in Ohio, maybe it's in Michigan, maybe it's California. So those are big distances. So when companies come here, they don't understand that there's different states, there's different things that they need to do in each state, and they're going to have to travel large distances if they want to meet with some of their potential business-to-business customers. So it's a big market, both in terms of the market size, but also geographically. And it's not, you don't have the ability to, if you're starting from Europe, let's say you're a Romanian company, you can build your business in Romania because you have regardless of your industry, you can build your business there and then say, I'm going to expand outside of Romania to the rest of Central, Eastern Europe and maybe Western Europe, and eventually, if I grow enough, go to the U.S. Here, you don't really have the opportunity to do that unless you're in very, very specific industries. So if you're in Detroit and you're serving the automotive industry, or if you're in Houston and serving the oil and gas industry, other than sort of pockets of examples like that. So if you're in the event space, right, and have a technology for event marketing, we're looking at a company right now. There are events, concerts everywhere in the U.S. So you need to travel. You need to go where those customers are. So you are not able to build that geographic beachhead and say, I'm going to conquer Texas first and then expand to Arizona or New Mexico or whatever. It doesn't necessarily work that way. You have to look at the U.S. as one large market, and maybe you identify California, New York, and Chicago as your three biggest cities, but those are about 3 hours away from each other by plane. So it's a little bit of a different mentality. And then the language is another thing that often is a challenge because, a lot of people may speak English well, but, when they're in a business environment, it's a different level of challenge, and they need to be, I think we're at a point where accent is not as important as assertiveness, but those two tend to go hand in hand. So if someone doesn't feel comfortable with their English, then they're not as assertive, and they're going into a sales meeting and they're not really presenting their company in the best light because they don't have that comfort level. So a lot of what the accelerator does is works with these companies and the founders in particular to help them improve the way they communicate in a business setting. Because again, all of our companies are B2B companies. So eventually they will be in a conference room or at a lunch table with a prospective client, and they need to know how to pitch their company in the best possible light.
Yeah, no, definitely. That makes sense. And on your side, what makes a founder stand out to you? Vision, ability to execute, resilience, obviously.
Yeah, all of the above. I think the industry is changing, and by industry I mean the software industry, and it's becoming increasingly. So if you'd ask me 3 or 4 years ago, I would say technical capability is very important, and technical know-how, and kind of having a technical edge. I think that's becoming less important. Having a certain level of technical capability is table stakes, but it's not what we're mostly focusing on. So we really are looking for founders that have a passion about the market that they are serving with their product. So we just invested in a company that is in the restaurant technology space. And, if the founder, which he is, the founder is a big foodie, so he will try every restaurant in Austin. But if he was the kind of person that was cooking at home and It was going out once a month and if that, and it wasn't really into that kind of life, then obviously he would be the wrong fit for this business. So we want to see founders that have a passion for their business. And I think the most important component in today's time is founders that take action. The market in every vertical is moving incredibly fast because the tools have evolved to a point where someone who has passion can build something very quickly and take it to market and iterate. The old kind of saying of analysis paralysis is hugely problematic in today's age. So if you're sitting in a conference room trying to get your business model right and get your product features right and are whiteboarding and refining and refining and refining, you're going to lose. So when we look at a founder and evaluate their ability to execute in the US market, we want to see a huge bias towards action. Also, obviously, what goes with that is an ability to quickly do these micro pivots that are necessary. So, you act and then you make mistakes and you change and you act again. So it's a combination of not having kind of blindfolds and going in a particular distance as fast as you can, but we want fast action with that ability to navigate. If you've ever been at a busy day in Manhattan, and when people line up to cross the street, I don't know if you've experienced that, and then you have the light changes and you have these two groups of people coming together and very quickly trying to cross the street. And New Yorkers are great at reading each other. So you're going at high speed of walking towards another group of people, and surprisingly, no one bumps into each other. So that's the kind of personality. We're looking for someone who is going to be going fast, but is going to making those reading the market and making those small changes so he doesn't hit a wall or she doesn't hit a wall or another company, but at the same time gets to the other side of the street as fast as possible. And you don't really see that until you see them out in the market. And that's part of the advantage of the model, is that if you are in a conference room, we have this saying in the VC community, "Bet on the jockey, not the horse," which I'm sure you've heard before. What people don't talk about, though, is that in most VCs, you are evaluating a jockey without ever seeing them ride a horse. You're seeing them in a conference room. You're not seeing them at an event where they're pitching. You're not seeing them in a customer meeting. So you're trying to understand, by them pitching the company to you, which obviously is a very kind of, they walk in the room, they're in that pitch mode. It's not their natural kind of personality. And you're trying to understand, will this person be able to convince a customer? Are they going to listen to the customer? Are they going to get that feedback, incorporate in the product and go back? And that's very difficult to do. And there's a lot of cases where VCs, and I think that's a big part of it, a lot of these investments fail because you don't have the ability to actually see the jockey ride a horse. And if they change the horse, that's fine. But you're trying to evaluate them in a conference room, and that doesn't often work.
Yeah, that's true. Okay, your current thesis focused heavily on applied AI. And what kind of company or use cases are you most excited about right now?
Yeah, so there's been a lot AI in the last 3 years. It's one of those things, right? I studied AI 35 years ago, and we went through a couple of AI winters and changes, and obviously there's been some really disruptive changes in the last decade in the core technology. But people bucket it all into one now, and they're like, okay, this is an AI company. And there's been a lot of, especially recently, articles of, are we in a AI bubble and are AI companies overvalued? And what really always kind of captures the headlines, because that's what sells, is big numbers, right? So if you look at the technology stack of what and the kind of full AI stack looks like, you start, when you look at the bottom, that's the place where you need the most money, it's hardest to innovate, and where there's established companies. So at the very bottom, you're talking about the silicon and the data centers. And obviously, the entry checks there are, $500 billion. We're not going to see any new companies in that space. NVIDIA is already owning the chip component. Now you have AMD, you have others that are kind of trying Broadcom and a lot of the Googles and OpenAIs of the world are trying to create their custom chips. So they might be able to create something and, take a little bit of market share away. So that's at the very fundamental bottom, huge checks. And then on top of that, you have the foundation models, still very expensive game, the tens of billions to play in that game. But you have a little bit more competition there. You have companies, you have folks that have left, from OpenAI, from Google, and have launched their own large language models. I don't think we're going to see too many more of those because, again, that price tag has increased. But what all of that is doing between the data centers and the new chip capabilities and foundation models, it's enabling that middleware and dev tool layer on top of that, which again, less expensive, but still a big game. And then on top of that, you have the application layer. So everything that's happening underneath is a tailwind to provide better tools and capabilities for the application layer. So if I'm building an application today versus a year ago, even if nothing else changes, my application today will be faster, cheaper, and better than it would have been a year ago by things that have nothing to do with what I'm doing, but with what's happening kind of at the levels beneath me. So that's a good tailwind for application layer. So we invest in the application layer. I think that's where a lot of the asymmetric returns will come from. The rest is necessary, and I think those companies are going to do well. There might be, there's always this question of, are they overvalued? I view it from the perspective is, are they going to be going after a business that is going to be significant? And I do think that. I think AI is going to disrupt every industry much more so than the internet did. And so eventually those companies are going to be seen as kind of the fundamental push for that. So I think all that investment is necessary. But if you're an investor that can't cut $1 billion check, and I would argue even if you can, then there's a lot of asymmetric return to happen from the application layer. So what we're focusing on the application layer is really areas where companies are going after a vertical with a passion. They're identifying a problem that AI can solve better today, but also they're kind of looking into the future and saying, how will the improvements at the bottom of this stack help my product within this specific vertical? And within that, what we're looking for is our own version of reinforced learning, if you will, meaning that, and I'll give you an example for the company I mentioned, Mately. So Mately is a voice reservation system. So you call up a restaurant, or it goes beyond that. They're talking to hotels and other service, but let's focus on the restaurants for now. So you call up a restaurant and you want to make a reservation. A surprising number of those reservations is still happening by phone. And it may not be just a reservation. You may want to have, get information. So do you have a gluten-free menu? Do you have a kids menu? Do you have heaters at the outside patio? Because, Austin now is getting to the point where you might need that. So a lot of information about the restaurant, about their menu, about the seating. Is it good for business meetings? I want to be seated at a quiet area. And it's a very natural conversation that you have with this AI receptionist. And then it hooks in with the main reservation platforms in the US, and you actually end up booking the table via voice. When I do that as a consumer, 90% of, if not more, I don't know the data, but I'm just guessing, of people will call from a cell phone because most people don't have landlines anymore. That becomes a unique ID to me. So if I call a restaurant in Austin and I ask about a gluten-free menu, and next week I'm traveling to New York and I call another restaurant that's also powered by Mately, that other restaurant has learned that my phone number is attached to someone who is interested in a gluten-free menu. And they can leverage that information to provide me a better service. Now, that information is new data that resides within the Mately ecosystem. It goes back to what I said earlier. It's not accessible by the LLMs. The more people make those calls through Mately, the better the system gets to know me, the better experience I will have on my next call, the more likely I am to continue to use the service. So there's a tie-in component in use. It almost reminds me of the frequent flyer programs with airlines. The more you travel, the higher your status, the more miles you earn, the more upgrades you get, the more incentives to use that same airline. So those are the kind of feedback loops we're looking at. There's another company called Timeline that does something also very interesting. They're using AI to they plug into over 200 different platforms that organizations are using, from their communication systems, their Slacks and, their emails and Teams and everything else, their project management system. The CHROs are using it. for their integration with Workday. It's collecting all of this data and metadata about your most valuable asset, which are the employees of the organization. And then leveraging that to provide a number of services. So if you're looking to put together a team for a new project, the system itself, it's called Timeline, knows that I'm a late owl and I stay up until 3 a.m. working, whereas John is an early bird and he wakes up at 5. So maybe we shouldn't be on the same team because that's not going to help us overlap. Or the fact that, I have this time zone might mean that I'm better suited, to work with someone in Asia because they're waking up before I go to bed. Or that, I have certain capabilities, what I'm doing today, but 3 years ago I was on a different project and I have the skill set that's required on this project. That's information that Timeline is enabling. The more people use it, the more other systems are plugged into it, the more the intelligence about that organization, about that workforce becomes valuable. And again, that's information that's not widely available outside of Timeline. So it's not, that's the defensibility against what we said earlier of, 100 startups dying. If you have that feedback loop where you're getting, the more you're being used, the more valuable the system becomes, and the data is not available outside of the organization or outside of the company to these LLMs, I think that's a defensible moat. So those are the types of companies that we really gravitate towards.
That's two great examples, and I love what they're doing. It's incredible. Okay, and thank you for sharing. And looking ahead to 2020, how do you see seed stage by investing involving?
It's not that far. It's 40 days. What is it we have left? I think it's
That's true.
well, there's going to be and it's already started, a tremendous number of startups. And I don't want to misstate this fact, so I'm not going to say it, but I was hearing something yesterday in terms of the number of the number of unicorns that have been launched in the last 2 years. And it's a 3-digit number. It's insane how fast companies can grow in valuation. And I think we're going to see, but I also think that's a function of how easy it is to launch a company. It's to a certain point, it's a numbers game, meaning that the more startups you have, the more successful startups you'll have, but you also have a larger number of unsuccessful startups. So there's a couple of things that are happening. One is the cost to launch something is effectively zero right now. So it's your time, right? So if you're a founder and you don't need a paycheck to put food on the table, or you have another source of income, or somehow you're going to eat, ramen noodles for a year, you can launch a product, not an MVP, not a beta, a product in market where you can sign up customers and bootstrap much easier than at any time before. And I think that trend is going to continue. Now, what that requires is significantly accelerated learning. So, if you wanted to learn how to code 10 years ago, you would go to a coding academy and or if you didn't learn it on your own and you had 6 months and you could learn how to code and get a good job, you need to stay on top of tools on a daily basis. Every morning, I probably spend the first hour and a half of my morning just catching up and maybe doing some very light testing of new tools, new technologies. There's always a new announcement, and really just to keep up with what's happening, because a lot of that, if you don't keep up with it, you might end up saying, okay, I'm going to launch a company and not see some of the trends that are happening and not be prepared for that. So the ability to learn very quickly and launch and pivot very quickly is the most critical component of launching a company. So I do think we're going to see tremendous amount of new companies. Now, most of them fundamentally, regardless of what they think, are not going to require that much capital. So I think the amount of capital that's going to be invested in at the application layer will probably remain the same, potentially even decrease. There is humongous amounts of capital that are being invested already and will continue to be invested at the other layers underneath the application layer. And those are going to drive a lot of the capabilities. Obviously, data centers is already a huge component. Energy is something that people are now starting to realize is going to require not only investment, but potential innovation. That might be micronuclear that a lot of people are talking about, but these data centers require insane amount of energy that we really don't have. I don't think any country has right now. And as these are built out, then you need to think about the energy requirements. So I think a lot of the investment is going to continue to go at those bottom layers. But what that does is it's a fantastic time to start a company because, you still need to hire some people. I think within our vertical, which is B2B, whether it's this kind of communication, virtual or in person, it's going to be a while before an AI avatar can sell and get a $1 million contract or even dollar contract in software from an organization. I think there are too many old folks like ourselves that are still in those positions, and until there's a generation shift, it's going to be a while. So having those skill sets within your organization, if you're focusing on selling to enterprises, I think are important. And that's probably where most of the money will go. So I can see a situation whereas in the past, the majority of the capital went to either infrastructure or more lately to engineering talent, a lot of that will move over to the business development. Now, if you're launching something that's a consumer app or you're doing all of your marketing through social media and you really don't need people, I can definitely see, a 2 or 3 person unicorn happening very easily where they just say, okay, we're going to rough it for, a couple of years and build our company and not take any external funding. And some of those companies are going to be wildly successful. So it's going to change, but I do think we'll see either a flat or maybe a reduction of the capital flowing into the application layer, not because necessarily of a lack of interest from the investors, but because that layer is going to require less and less capital while the underlying layers are going to require more and more capital. And the market's going to shift to adjust to that and to put the capital where it's needed the most.
Yeah, no, definitely. And for your own fund, what's next for IA Global Ventures?
Yeah, I mean, we have a pretty unique model. We're a new fund. We launched last year. We had our first close. We're still fundraising. So I need to focus right now on 3 areas. So one is fundraising for our final close, which is going to be early to mid next year. The second component is making new investments. So we're at 5 investments so far. Our goal is to invest in 25 to 30 companies. I think we're going to make at least 1, possibly 2 more investments this year, although it's getting close to the end of the year. And then continue to work with our existing portfolio companies and help them grow, help them find the next round of capital, and make a lot of introductions and help them, accelerate their development. So for us, it's a very I love where we are in terms of our positioning because our companies don't require a lot of capital. Their engineering teams are abroad. That has always been a significant advantage. I think the delta between an engineering team in Eastern Europe and an engineering team in the US has grown, not because the Romanians or the Polish or, the Czechs have become cheaper, but because their US counterparts have become much more expensive. So we have a big advantage when it comes to the cost, and the engineering talent is fantastic. Of course, India as well. We have several. That's the biggest supplier of our companies comes from India, and we're seeing a lot of innovative approaches. Going back to what I mentioned before, which is finding an area of sometimes it's a boring industry that we may not think of, but finding an area that the founder has a passion about, that they can leverage AI to build the product very quickly and then launch the product with not a lot of capital and get that feedback loop and start learning and build that moat very quickly. So I'm excited about the deal flow we're seeing. I'm very happy that all of these investments and the underlying models and infrastructure is happening. A lot of times I talk to our LPs and they'll say, well, what if the incumbents, everyone uses Google for some reason. What if Google decides to do this, or they used to use Google? The reality is that history shows that that usually is not the case. And there are many situations where the incumbents have had a huge competitive advantage, and they didn't use that effectively. If you think of Spotify grew within an ecosystem where Apple should have dominated from day one. They owned iTunes and they owned the music experience. Before them, you're old enough to remember that
Sure.
Sony used to own that music experience with the Walkman, and they never made that transition, or they made it too late. There's many other examples, and you see some of them in the AI space already. So I don't think, when I talk to our startups in terms of the competitive landscape, I say you guys should be worried about the other startup that's somewhere else doing what you're doing. Don't worry about the LLMs. Don't worry about the big companies. The big companies' operating mode is to stay on top of all this and find the optimal time to acquire a company. Sometimes they miss that window and then it runs
Sure.
away from them, but that's really their mode. They don't want to take all these risks internally necessarily. And, so as investors, what we look at is, can the company build that defensibility and that moat very quickly versus other companies in that space. But no, I'm excited. We have people from all different countries in our office. A lot of different foods are being cooked, and people bring different cuisines, and it's always exciting. And
Fantastic.
just a multitude of cultures, but they're all very much focused on building fantastic tech that's going to disrupt their respective industries, and so they have that as a common thread. Yeah, so it's a lot of fun.
That's great. That's amazing. Nikos, this has been a fantastic conversation. Thank you so much. I really appreciate your time and your insight. You have given funders and investors real insight into how to think about AI and global scaling. Thank you so much.
I appreciate the opportunity. Thank you, Laurent.
Thank you. And that's it for today's episode of AI Interconnect. And if you enjoyed it, share it with someone who is building the future, or better yet, someone who should be. And until next time, stay curious, stay creative, and keep building. Thank you, Nikos.
Bye bye. Thank you.